So the big news just dropped. Michael Burry is betting against Palantir. And look, this isn't some casual trade or a simple hedge. We're talking put options, expiring way out in 2027. This is the guy from The Big Short, the man who saw the 2008 housing collapse coming while everyone else was laughing at him. And now he's got a massive short position against one of the hottest AI stocks on the entire market.
So yeah, the big question is, what does he know? What's he seeing that maybe the rest of us are missing? And the answer, well, it's not really hidden in Palantir's financials. It's not about their revenue multiples or those big government contracts. It's actually much, much simpler. The very AI that Palantir is selling, somebody else is now basically giving it away for free. Okay, let's really dive into this.
All right, here's how we're going to break this all down. First, we're going to ask, what is Palantir really? Then we'll get into this thing called the China discount. Third, we'll unpack Michael Burry's whole thesis. After that, of course, we've got to cover the counterargument. Then we'll talk about what the market might be missing. And finally, we'll get to the final take. Okay, let's kick things off with section 1. Who is Palantir really? I mean, if you've been following the tech world for the past decade, you have definitely heard the pitch. Palantir bills itself as the AI operating system for the modern enterprise. It's the platform governments and huge corporations turn to when they need to make sense of just massive, messy piles of data. We're talking about the CIA, the DoD, ICE. They've all used it. See, Palantir isn't just selling software. They're selling this whole intelligence layer. They call it AIP, their AI platform, that's supposed to sit on top of all your data, all your workflows, your entire decision-making process, and turn it all into something a CEO can actually use. And they call it an operating system for a reason. That framing is super important. Because think about it, once you're on an operating system, you pretty much never leave. The costs to switch are just brutal. You build everything on top of it. You start to depend on it. It becomes part of your infrastructure. And that right there is the whole bull case for Palantir. The lock-in, the powerful moat, the compounding value. And for a while, at the peak of the hype, the market totally bought it. I mean, Palantir hit a price-to-sales ratio that made even the most optimistic investors a little queasy. At one point, the stock was trading at over 60 times its revenue. Just to put that in perspective, Microsoft, one of the greatest companies ever built, trades at around 12 times revenue. That's the kind of premium you get for what people think is irreplaceability. But here's the problem. Palantir might not be so irreplaceable anymore. And that leads us right into section 2, which introduces the single biggest threat to Palantir's whole business model, something we're calling the China discount. So picture this. It's January 2025, and this Chinese AI lab called DeepSeek just drops a bomb. If you missed it, they released a new model, DeepSeek V3, that on most of the standard tests either matched or flat out outperformed giants like GPT-4 and Claude 3.5. Now, that alone would have been big news, but that's not even the main story here. The real story is what it costs to actually run the thing. And here is the absolute kicker, the cost. To run DeepSeek V3, it costs just 14 cents per million tokens. Now compare that to Claude 3.5 Sonnet, which costs $15 per million tokens. No, that is not a typo. That is a 107 times price difference for basically the same capability. Just let that sink in for a minute. And it gets even crazier. DeepSeek is open source. You can just download the weights, run it on your own servers, host it yourself. License fees? Zero. API costs? Gone. Being locked into a vendor forever? Not anymore. Palantir's whole promise with AIP is that it brings this cutting-edge AI to your business. That's the value. But what happens to that value when someone else offers that same cutting-edge AI for literally 1% of the cost, with no strings attached? Well, you get what the market is now calling the China discount. And it's not really about China. It's about the fact that AI is no longer scarce. Palantir's entire moat was built on that scarcity, and DeepSeek just blew a giant hole in it. So how does all this circle back to Michael Burry? Well, that brings us right to section 3, the Burry Thesis. Here's probably how he's looking at this whole situation. When you get down to it, Palantir isn't really an AI company. It's more of a systems integration company that bolts a very, very expensive AI layer on top. The actual brain power, the models, the reasoning, that's always come from someone else. Palantir provides the pipes and the dashboard. OpenAI, Anthropic, and now these open source models. They're the engine. So just imagine your mid-sized company. You're paying Palantir a ton of money in licensing fees. Then someone walks in and says, hey, here's an open source model. It performs just as well, runs on your own cloud,
and costs a tiny fraction of what you're paying now. Oh, and we'll help you build out the custom stuff you need to do 80% of what Palantir does. This is the classic disruption playbook. It always starts at the edges. Smaller customers leave first, then the mid-market ones start to defect. And even if the big clients stay, the growth story starts to fall apart. And for a stock trading at 60 times revenue, you don't need a total disaster for it to collapse. You just need the story to get a little complicated.
And that's why the timeline of Burry's bet, those 2027 put options, is so critical. He's not betting on a bad quarter next month or a miss on next year's earnings call. He's betting on a long-term structural repricing of the company, a slow, steady erosion of Palantir's core value as these cheaper, more open alternatives get better and better. But hey, let's be fair here. Michael Burry could be wrong. I mean, he was famously wrong about Tesla. He's been way too early on a lot of his big calls, which in the market is kind of the same thing as being wrong. So that brings us to Section 4, the counterargument. So here's what the bulls are saying. First, those government contracts aren't going anywhere. The Department of Defense isn't going to swap out mission-critical intelligence systems just because some Chinese AI model is 100 times cheaper. Second, those enterprise switching costs are very real. If you spent 2 years and millions of dollars building your entire company's workflow on Palantir's platform, you don't just rip it all out overnight. And third, this advantage DeepSeek has might just be temporary. You know, the big US labs are all racing to cut their own costs. And look, these are all totally legitimate points. But here's the thing. For the bull case to work, Palantir has to keep that premium valuation while the entire ground is shifting underneath it. That's a really high bar, especially at 60 times revenue. But the bear case here goes even deeper than just direct competition. So what is the market not really pricing in yet? That's what we're going to cover in Section 5. What people might be missing is the ripple effect of AI becoming a commodity. Think about it like this. What happened to old-school enterprise software companies back in the 2010s when cloud computing took off? Giants like SAP and Oracle didn't just disappear, but their crazy growth multiples got squeezed. Their moats started to leak. New competitors popped up, offering 70% of the features for 30% of the cost. The really high-end clients stayed, but a lot of others left. Palantir could be at that exact same kind of inflection point right now, but for AI infrastructure. And you can't ignore the whole geopolitical angle either. There's a very real chance that US regulators could eventually restrict the use of a model like DeepSeek in sensitive government work. And yeah, that would definitely help protect Palantir's government business. But the commercial side, that's a much harder business to protect. And it's that commercial growth that's been driving Palantir's sky-high valuation. All right, so after weighing the bull case, the bear case, and all the market dynamics, let's get down to the final take. You know, Michael Burry doesn't make these kinds of big bets quietly, and he's definitely made one here. When you boil it all down, his thesis is actually pretty simple and kind of elegant. Palantir built a premium AI platform for a world where AI was a scarce resource. And thanks to things like DeepSeek, AI doesn't have to be scarce anymore. The platform still works, sure, the customers are still there. But that justification for the premium price tag, the lock-in, the moats, the whole idea of being irreplaceable, that is just getting so much harder to defend. The risk here is real. A stock trading at 60 times revenue needs absolutely everything to go right. It needs the story to hold up. And that story, of Palantir as the essential AI operating system, is now competing with a world where AI operating systems might just become free. That is not a comfortable place to be if you're long this stock.
So is he right? Well, probably partially. That government business is stickier than a lot of bears think, and those switching costs are very real. Burry could easily be 2 years early on this, which, let's be honest, is pretty much the same as being wrong. But keep an eye on their commercial revenue growth. Watch for customer churn. See if that China discount starts popping up in Palantir's sales calls. So I guess the final question is this: is Michael Burry right, or is he just 2 years early?